Welcome to Upside, where we dig into the real stories that live behind the headlines affecting European venture. Today, Lomax, Andrew, and myself are going to be talking about, we're going to change up the format ever so slightly, have a little quick news section. I'll throw some things in the hat and then we can see what we want to focus on. Then for some deep dives, we're going to be looking at Germany's lithium find. It is quite a haul, so we're going to have a look at that. London drops out of the IPO top 20 by some margin. Should governments bail out? Should governments support startups and businesses? JLR in mind in the UK, but taking a look behind the scenes there. Reinventing venture capital, one of my major bugbears. I want to talk about this, but let's see if there is anything to talk about in reinventing VC models. And then we have deals of the week.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So, gentlemen, before we kick off, Lomax, Andrew, how are you? Lomax, what's happening with you?
I'm great, thank you. I'm very good. We're experiencing the most outrageous weather in Portugal.
I hate you.
It's like summer, so it is beautiful.
Love it.
Had
And we're October
outrageous surf session at lunch yesterday in between calls.
Because you're a VC working really hard.
I am working hard, but I also like to take an hour out of my day to clear my head. I think that's allowed. You know, Stebbings and his 996. I totally agree with you, but the need to work hard to build big companies and also build successful venture firms. But you got to be able to look after yourself as well.
Yeah, totally. And getting in the flow in the water, I bet, is a real palate.
Well, I don't want to make a joke about a board meeting, but I was out there with my partner. Too easy.
Do you talk work, or do you just get on with it?
We do actually. If we're halfway through a meeting and the surf is good, we will put our wetsuits on and we will continue the meeting in the ocean. And actually,
what a lovely way to live.
When you're running a small organization like ours, where the important decisions are made just between the two of us, you can get away with doing things like this. Yeah, it's a privilege, to be honest.
Yeah. No, what a gift. Andrew, what's happening with you?
Well, that's just all too cool for school, isn't it? I've got nothing to compete.
I'm not surfing, I'm assuming.
I've been back in London this week, wheeling, dealing, doing deals, seeing some of our portfolio companies. All good. Everyone's trying to be optimistic, despite the government doing its best to crush us all.
Seeing the upside, good. Well, part of the UK government is going to be part of our first quick news sesh. So for this bit, gents, keep it really short, sharp, snappy. Let's see what we want to talk about. So what was on my mind this week was looking at the American government shutdown. Is there going to be any effect on markets? The Labour Party conference. I know, Lomax, we were talking about this. I also saw this week that the UK is trying to keep the $5 billion that it recovered from the Chinese nationals who'd committed that Bitcoin fraud. So maybe we can get another 5 billion into the coffers. That would be nice. I saw also that the UK government has asked Apple again, this is the second time, to get a backdoor to data. I think that's just a bloody disaster, but maybe there's something to discuss there. OpenAI looking now is a $500 billion company. I bet Elon is pissed at that. Now he's what is it? SpaceX was $400 million, wasn't it? So this is now. So Sam Altman has now beaten Elon to be the most valuable company in the world, and something that also very poignant for us: entrepreneurs first, no longer entrepreneur first. EF has now moved out of Germany and France and are focusing on the States, which I had a bit of a visceral reaction to. So Lomax, I don't know if there's anything in there. Did you?
I loved it. So yes, because. Well, as I've said to you before, Dan, at Outside, this is a key part of our investment thesis anyway. More on it when we get onto it.
Okay. Oh, and also Sora 2. I bet everybody has seen the Sam Altman videos being created with Sora 2, the OpenAI video generation software, which is unreal. I mean, every time I watch all of the latest updates on the latest video generation platform, this is just absolutely crazy. I'm slightly fearful now for AI generated video and what it can actually do and how it can influence the media and news and creators. But anyway, so
you get flushed down the loo by your own product, it seems. Yeah.
I saw the one of Sam Altman stealing GPUs from the store and being on the CCTV and being stopped by the security guard. It was obviously all AI generated. It It's like, but I need this for a new Sora release. It's like, this is just so cool. Anyway, Lomax, what would you pick on out of that stack, if anything?
Well, we could do the Labour conference quickly and get that out of the way. Big picture, I think by all accounts, Starmer gave one of his, he's had a terrible year, right? So he's the most unpopular prime minister in history, 13% approval rating, and Labour are only now at 20% in the polls versus Reform, which are 35%. And this is only 15 months after they won, a really, really big, nearly 200 seat majority in Parliament, right? So they came in the middle of 2024 with a huge mandate, and they basically snatched, what do we say? Snatched victory from the jaws of defeat, or snatched defeat from the jaws of victory in this case. So it's been a difficult 15 months. We know that, and I've talked about that a lot here. I think Starmer gave what was by all accounts quite a strong speech, but lots of
Was it though? Was it?
Narrative. I would say narrative better, but weak on policy. Again, actually,
but
not
how much is
not
personality?
Enough
do you think? I think this. You could also frame this at founders and business leaders. Forget politics for a second.
Yeah.
It feels like the country needs a strong, bold leader when you've got characters like Trump and Putin and Xi doing his show of power. So it feels like, and I remember, and I've said this before, but I remember thinking, great, we've got this really sensible, thoughtful, smart, kind human in office. That's just what we need. And I couldn't have been more wrong. We needed somebody who's strong and, a big, great orator and a powerful leader. So how much of it do you think is
a lot of it's some of it's personality driven? No, for sure. There was an interesting article in the FT, I think it was a couple of weeks ago, where the journalist made the point that, taking the US, for example, it's all the Democrat leaders over the past, 4 or 5 incumbents had all been trained as lawyers, right?
Really?
Yeah. And it's and that starts to really show,
Was Clinton a lawyer?
By training.
Starmer's speech was just, it was awful. It was sort of polished to the point of robot, cautious, profoundly lacking in urgency or inspiration, I felt. He sort of, it was almost like it had been spun to, it's a classic kind of political speech with no real, with none of that leadership that we were all looking for, I felt.
I follow him on Twitter and, or X or whatever it is, and it is that the messaging is extremely old school, kind of 80s inspirational poster with no connectivity to the audience. I know it's only kind of
connectivity to their policies in many cases. It's a long time ago saying, Purcell washes wife the white stopped working, right? The electric and the audience have become wise to advertising that doesn't stack up. It's just naturally now we're far more information aware, and that's why you're reading it and you're feeling that this is just a bygone era of advertising.
I would say, to be honest, not much for us in our world. I don't think a lot came out of the Labour conference. We have the budget in November. Some interesting or non-interesting things or difficult things will come out of that. I think the most interesting news this week actually is going to come out tomorrow, which is the Office of Budget Responsibility, who will be releasing a report publicly, which will downgrade the UK productivity numbers going forwards, which will basically cut significantly.
Never believe the OBR stuff. The OBR stuff is always wrong.
Yeah, but this is important because this will cut the projected, growth in the UK economy and the tax take that Rachel Reeves is assuming that she will take in the next 4 years of this government. As a reminder, her fiscal rule is basically to balance the books on a current spending basis. So we meet all expenses except for investment, but operating expenses out of tax, right? So we basically balance the books that way. We can still borrow money, but that will be for investment in infrastructure, capex, etc. That's her plan. She has 10 billion of headroom over the next 4 years. And with this downgrade, that will flip that 10 billion of headroom into a sort of 20 billion deficit. So we uncover yet another black hole, which will kind of, then paint a grim scene heading into the November budget, which means she'll probably try and find even more money from business and entrepreneurs, etc. So that's the big worry that could affect both sentiment and actually the pockets of the people building in the private sector.
So this then leads into another topic I know you wanted to pick out of the quick news section, which is EF now focusing on the States and leaving Europe. I mean, they're not leaving, but there is now such a big push from Entrepreneur First, which was UK, very UK centric, then very European centric. They've closed everything, but maybe I think Bangalore and the German hacker house. I think they've now, I don't know, now the Germany piece is gone as well.
I would describe this as a consolidation. I mean, I'm now being EF, and they've done such an amazing job, Alice and Matt, building this into what it is. I think it's a recognition that they're still going to be able to pull with their brand the best of Europe who want to join, into either a UK or ultimately the US cohort. So all entrepreneurs now, they spend some time in the US, they have the opportunity. It's something we've talked about a lot on this podcast, which is the urgency in the US is, there's no comparison, and the willingness to buy of US customers versus the continuous procrastination of European customers, often from a startup point of view. And so I think sheep dipping founders is really smart. For a long time, we've pushed founders to go and spend time there. We introduced them locally. I think over half of our portfolio companies have ended up top coding in the US, either because of customers or because of the need for later stage investment there. So it's not going to change in the short term, and I think it's only a good thing. Ultimately for Europe, it's a good thing because
but they're all Delaware C corps. They're being flipped straight away, and I know that I'm an emotional creature, and I cannot answer this question emotionally. It's just no point. It's just a pointless thing. It just feels just like a loss. I feel a little bit like there's a loss in the family. That's what it feels like to me, which I know is a pointless statement. And follow the money and follow the customers, and it's absolutely a smart thing to do, and I get it. And obviously, Lomax, this is a strong part of your strategy.
I just cut the emotion out of it, Dan, and I'd be like, look, to be honest, in a way, this is validation. In a way, it's validation of the following thing, which is that European founders are getting better and better. It's a validation of that, okay? Because if that was a problem, EF would either be downsizing completely. I mean, don't forget, Matt has left, or Matt is doing other things. Like there's the business, Alice is doubling down
back,
here,
isn't he?
I would
Matt's
say.
back again.
Oh, is he back?
Matt's
okay.
back.
Well, they're doubling down on the quality of European founders. But one thing I think that they are, evidencing by this, or one of my takeaways from this is that this notion that you can raise pre-seed and seed in Europe, and if you want to try and tap into the bigger kind of early growth and growth money in the US, we know that, in terms of rounds of between $20 and $100 million, there are 4 times the number of those rounds in the US than there are in Europe. If you have completely European DNA or UK DNA in your company, it's actually very hard to tap those US capital markets, right? I'm a big believer, actually, this is what we also believe at Outsized, and Andrew believes that it's 7%. You need to weave more US DNA into the companies from early on in order to go and tap those big capital markets, and also like customer markets too, and also hiring talent. So I don't think it's a bad thing. I think they're playing the game as it is on the field. And I think, off the back of this, and actually if you look at the conversion rate of companies that leave Europe to the US and then become unicorns, it is much higher than, companies that get funded here and then become unicorns. So I think there's a kind of, hopefully we will see even more successful companies come out of this. I mean, EF is clearly a great early stage talent magnet, and they're gonna propel and accelerate those people.
There's also just a practical factor to this, which is, EF's model is to bring together the smartest people and to pair them up and to build those businesses. So there is value in clustering. There's value in not having those centers distributed. If you stick everyone in the UK or the US into that cohort, you can argue that you're going to get a far better match rate and stir the pot all in one place. It's about clustering talent and capital. So focus is often not bad.
I will park my my inappropriate emotions elsewhere, and wish them well. Right. Well, anything else in the quick news bucket? I mean, I don't think there's much to dig into.
US government shutdown. I don't think much to see there from a kind of like, it's just a reminder that it's less about numbers, more about symbolism, really.
Well, markets don't tend to move horrifically. I mean, I saw the S&P today. Nothing has moved. It's business as usual. So nothing. I think the expectation is that it's going to be a fairly quick turnaround, and that the Republicans will probably get their way and the Democrats will probably bend over. So I don't know. I don't know if there's anything that's going to then leapfrog over the pond and affect us, but we will see.
No, the only interesting statistic that I read was that for every week that the shutdown continues, the US, GDP loses $15 billion. So,
really?
there's some numbers.
So there is an effect. Okay, it might not be a market effect, but there is an effect.
GDP effect, yeah.
Yeah, interesting. And of the last 8 shutdowns in the last, whatever, I think 4 were under Trump. So obviously he's a contentious character. So
well, it's a reminder that
deals with
Trump
this one.
can't always get his way as well. There is some like democratic safeguards.
Well, he's threatening to just fire everyone. He's basically saying for every day that we're closed, we're just going to fire another swathe of, which I'm assuming will be mostly Democratic representatives. All right, well, let's see what happens on that. Let's come back to Europe. And we found out this week that Germany, or North Germany, has a massive lithium deposit. So I was looking behind the numbers here. So 43 million tons of lithium has been found in northern Germany. Obviously critical for battery technology, but I'm sure I don't need to say that. Also wondering where this fit in context with how much lithium there is and how much lithium is required to build batteries and da-da-da-da. And in 2023, the world mined 22 million tons roughly globally. Australia, Chile, and China are the largest producers. I always thought it was China, but actually Australia is the largest producer by a sizable margin. I think nearly 40% of all lithium in 23 was Australian. Then it's Chile, and then it's China in that order. Now, if extractable, Germany alone could cover around 50 years of EU consumption with this haul at 2030 or suggested 2030 levels of use. So this is a massive haul in context. But can they get it out the ground? What about the environmental, regulatory, social constraints? If they can get to it, will this make Europe self-sufficient? How is it all going to fit together? Lomax, tell us more, and then we'll dig into some of the details.
No, and well, I know just to set the scene and context here is that we are now in an era where everyone is driving for sovereignty over everything, defense, compute, and also now obviously critical, raw materials, where Europe is, infamously kind of lacking. I think Portugal, where I'm sitting, is the biggest producer of lithium in Europe, and that produces less than
Spain and Portugal have both got reserves as well. Yeah.
Producing like less than 1% of the world's supply, right? So it is Australia, China, and Chile, the main producers here. So I think this is interesting, and I think this is in the ground. This is worth nearly 600 billion in ground value, right? This lithium, and so it's great to find it. As always, when you look into the detail, things are more complicated. The extraction method here is direct lithium extraction from brines. So it's not traditional open pit mining. So for our environmental footprint, I think that's probably good. But even then, there will be, water table concerns. And as always in Europe, this is a densely populated area. So, our friends, the NIMBYs, are going to be causing problems when it comes to permitting. The other old friend that we often speak about is energy prices. So this is going to be expensive. Europe, the UK have some of the highest costs of industrial energy in the world, and that's not changing anytime soon. So, the costs of this project are going to be very, very high. The permitting costs are going to be high and both take a long time. So I'd love to be an optimist about it, but it really feels like this may just be something that just sits in the ground and never comes up. It's not Australia where you can get this stuff spun up in 6 months because it's in the middle of nowhere. Also, the technology here, unlike open pit mining, is still nascent. So there's still actually a bit of de-risking to do on the this direct lithium extraction method, which is not a slam dunk. So it's not proven at industrial scale. But maybe, to try and be an optimist here, maybe if Europe is going to invest, let's assume this all gets too difficult, is maybe a place that Europe could invest is in refining, refining lithium, right? So we could probably secure long-term supply from Australia and Chile, obviously not from China.
It feels like that will be part of the
raw materials.
The new world order shuffling will get more friendly fire raw materials and rare earths and whatever is required.
And just to remind you, to bring it back to the Labour conference, Ed Miliband outright banned fracking forever in the UK. I know we've been in a kind of de facto moratorium on fracking since 2019, but because of basically high population density, NIMBYism, environmental concerns, fracking.
But it's also
which
really
is,
expensive fracking, isn't it? So it's
hang
the
on a
most
second, Dan.
expensive
Sorry,
extraction.
what's driven what, the US like shale oil boom has been like fundamental in the economy of the US of the last 20 years, right? And also driving sovereignty over a critical, natural resource.
Yeah, but the US has always produced more oil than it needs. I mean, it's always been it's been in a mega surplus for decades. So I don't fully understand the mechanics of, maybe it's just on the refinery side? Maybe they then need to ship that dirty oil elsewhere to then be produced, to then be shipped back to the States. But they're swimming in the stuff. They're swimming in the black stuff.
Well, I mean, they need it. The world is still driven really by oil, right? So anyway, my point is, in Europe, it's very hard to do any of this stuff. It's probably a waste of time, but actually moving into something like refining it, maybe then is, securing critical supply chains from more friendly geographies and refining it is probably what the Europeans should focus their efforts on.
The refining is going to be the bottleneck, not the geology, I think. So unless Europe builds its own battery gigafactories and the refining capacity, then
they're coming.
You can dig the lithium out of the ground, but it'll still end up powering cars made elsewhere. So it's a great first step, and to wean ourselves off dependency. All good, but a lot of the rest of the stack needs to be in place as well.
I mean, obviously there are so many new battery factories coming online. So, and I always look at the BYD. I mean, they own their entire supply chain from mining to software, the full stack. And I do believe that that's where Europe is trying to get to be more self-sufficient. And I'm also very keen-eyed on sodium technologies in battery, where you won't need as much cobalt, lithium, and other more traditional battery technologies. And it feels like that is close. So there even might well be elements that are much more abundant across Europe that will affect battery technologies. But anyway, it's a good thing. It's been found in our backyard, and there are potential opportunities to do good things, which I think is not the usual story that we get. Let's move on to the London IPO scene. We are not going to spend too long here because it is a pretty dreary story. However,
it's worse than I thought, actually.
Yeah. This week we found out that the UK exchange is ranked 23rd globally for IPOs, according to Bloomberg. So it's behind Mexico and Singapore now. The volume of IPOs
and
in London this year,
Oman.
Great.
And Oman.
Great. And Sierra Leone and Kenya and what was that tiny island that had penguins on it that Trump put
Sao
tariffs
Tome
on?
and Principe? I don't know. Yeah, okay.
Christ. Anyway, so so just for context, here's the London numbers, but then you've got to compare that to someone like the States. It's a bit nuts. So the volume of IPOs in London has dropped 69% from $248 million to 42. But if you just look at H125, US IPOs raised, excluding SPACs, this is 26 billion. So we're just not even in the same ballpark. So what do we need to talk about here? How the hell do we get out of this? Or do we just do something completely different and we don't even worry about IPO, some other form of something? I don't even know where to start, but Lomax, maybe set more of the scene.
This is now the end of a sort of 30-year decline that started probably in the 90s, right? With a chronic lack of investment in equities. Actually, people focused on bonds, in pension funds, which pension fund trustees who control roughly £3 trillion worth of assets, being incentivized both, I suppose, from the regulatory angle to invest in less risky assets, right? So I think that's one of the main drivers behind this. I think also a lack of it, this is relevant for us, is a lack of investment in technology in the UK has led to this, because, you look at FTSE 100, 1% of that is technology. You look at, S&P 500, about 30 to 35% is technology. So if you're, the biggest growth area in equities in the last 20, 25 years is tech. Yeah. And the UK is just completely, we still have AIM. The AIM is kind of a laughing stock. And so, which was the sort of smaller little brother, little sister of the FTSE to try and, or the London Stock Exchange aim to try and have lighter regulation to make it, quicker and easier and more nimble for young technology companies to list. But that has been a failed experiment. So we have lack of capital. We have lack of innovation, entrepreneurs listing their companies in Europe. And then we have excessive regulation. I think, the UK, we have some of the highest disclosure rules in the world. The prospectus rules are arcane. We still have 0.5% stamp duty on share transfers, right? Which many countries don't
What
have.
was Pisces? Pisces was just designed for like a light touch, enabling founders to get some money out, some kind of liquidity.
Too little, too late is what I would say.
But there is discussion this week. That whole discussion about stamp duties come back up again. That stamp duty should be waived for.
Yeah, I think they're going to do that.
Couple of years.
I think they're going to do
and
that.
So that
Really?
looks like a small thing that go through, but there is lots of other structural issues which are problematic.
I think the other thing that's happened is just like, it actually is like not globalization, but it's competition. For a long time, the UK and the US were the only games in town. Now you can list in many, many countries. Yeah. So I think it's just the way that other countries, and it's very sad for the UK because, financial services industry is, was originally 10, 11% of GDP. Like, it's a big part of the economy. So I think for the UK, it is a big structural problem. It, in a way, for us, backing young companies and working with founders, you could argue it's an irrelevance. It's like, if you're going to build a big company, you just go and just take it to market in the US. I mean, that's totally fine. Nothing's stopping you doing that.
Well, that's how we live, isn't it? I mean, they sell, raise, build, exit. They tend to do that elsewhere. I'm just always trying to find the angles where are the levers to pull to enable more listings in the UK or across Europe, because we see stuff going on in Paris or Amsterdam or Berlin. Not huge volumes, but it feels like there might be some levers to pull to get some more activity, make it more attractive in some way.
I mean, as always, like, you need more capital because, if you have more capital, you have, a greater ability to generate competition on your book building when you're raising money, right? Which means you're going to get a higher price per share, right? You have more liquidity, which also drives a daily turnover of shares, the ability to sell out.
But that would have
shares.
to be mandated, wouldn't it? That would have to be the one thing that I think Reeves has said she wouldn't do, which is mandating pension funds to invest in UK.
No, you have to incentivize or incentivize them, something like that. On the one hand, as I said, for us, we could maybe just view this as an irrelevance and be like, well, it doesn't matter because we're just going to go and list in the US anyway, and that is probably the answer today. But I don't. How to fix this is a more systemic, structural concern. Yeah, okay, so you cut red tape, you incentivize more investment in equities. What you would do as you were the government is you would actively court big tech IPOs to happen in London. It's hard, but you literally actively court these people.
But why would a founder do it? What would the incentive be?
There you go. It comes down to incentives. You subsidize some cloud compute for them in the UK or something. You know what I mean?
There's got to be ways. There's got to be levers. There has to be.
The good news, Dan, is that you were talking about how the Labour government has sort of adopted a kind of 1980s style of messaging and marketing their political messages. And they're talking about doing a Tell Sid style campaign to encourage people to put money into the stock market in the UK. Those who don't know, it's 1986. It was a British advertising campaign by the government during the privatisation of British gas.
I remember it.
It's this catchy slogan of, if you see Sid, tell him, urging ordinary people, in quotes, to buy stocks and shares. So, they're not only got the style of the 80s messaging, but they're going for substance as well by copying a playbook from way back when.
I hope that doesn't happen because they were doing that through high street banks, weren't they? That was the plan.
I mean, God, if they just fix the fundamentals and stop, they're always looking for these magic fixes, right? It's just suck up and fix the fundamentals. But no, Tell Sid advertising campaign.
This is actually this is a bipartisan issue. Like the Conservatives are just as much to blame here.
It's not. We all know the list of changes that needs to be made. Nobody will make them. I don't really understand.
It'll all be on Nige, and Nige loves
my pay grade.
It's Millet, isn't it? The Argentinian. He's a big Millet fan. Is that how you say his name? So we'll see. I'm sure we'll see some bold moves from Farage when he's in office in a few years' time. While we're on UK governments and UK government activity in business, bailing out JLR, so Jaguar Land Rover, which is incidentally is owned by Tata. They bought them from Ford in 2008 for, I think it was $2.4 billion or around that figure. So it's not a bailout per se, it's a loan guarantee of up to £1.5 billion. that was the lens or the thing that caught my eye this week, but I didn't totally want to talk about that. I was more intrigued by Germany shifting gears it's a massive pivot. If you look at how fiscally conservative Germany is around how they manage their economy, they never borrow too much. The massive export manufacturing market. And as we all know, and I've spoken about a lot, there's a lot of problems, and since COVID, even more problems. They've been exaggerated, where Chinese manufacturers like BYD are stealing the march on the German automotive industry. Trump's tariffs haven't helped. So Germany, who have always been very private company focused and letting private markets do what private markets do best, have flipped the script and are now effectively becoming the investor. 500 billion euros earmarked mainly infrastructure. I think last time I looked, 330 billion euros was focused on infra. But this is a massive shift. So looking at JLR and the UK government, and then looking at what Germany is doing, I'm thinking, well, maybe the UK should do the same. And I know there's some American money, which we've spoken about, the 150 billion coming in, but getting the UK to think more like the Germans, is this a good idea? Should we? It feels like we should go big and bold and almost trust-like, without screwing the bond markets. Just get some real kind of activity going on the investment side, some big bold numbers. But Lomax, is that nuts?
No, I think. By the way, there's a certain lithium mine that probably would like some subsidies. So
there we go. We can start there.
That's an expensive way probably to get through some of that 500 billion. Look, I'm all for government investment. I think that if you wanted to tie these two things together, you've got what's happening in Germany, and it's also happening in the UK as well, by the way. It's not as if like Rachel Reeves is not investing. Well, she's actually carved capital investment out of her fiscal rules, which gives her carte blanche, subject to the bond markets, to actually invest, right?
But it's still quite low rent, isn't it? It's still, we're talking in the
Germany
had
more, of course, like Germany had more more headroom to play with, effectively, because of the breaks they've had on the fiscal spending. I would say, look, if you're trying to tie these, given we started with the JLR piece, I'm all for government stimulation, catalyzing the private sector, right? And I'm all for that.
Let's start there. Should the UK government,
where things go? Yeah, yes, they should, of course, yes. But okay. Where things go
it
wrong,
depends how,
though. JLR case,
it's all about how, isn't it? Because basically what they're saying, Tata gets to sit there, huge conglomerate, and they say, well, this is all getting a bit awkward, and we might think about shutting the factory. And the government looks at it and goes, fuck me, 40,000 jobs we're going to go. And Tata has the government over the barrel and said, well, we'll carry on investing if you backstop our loan. And so suddenly, essentially, the UK public become guarantors personally for Tata's risk, and its profits. And where's our upside? And so it's all very well the government's becoming more sort of under the cloak of industrial strategy, involving themselves, but then they have to negotiate commercially appropriate terms, because Tata then has to look and stare in the face. If it knows the government has spine and is willing to suck up the political cost of loss of the jobs, then you have leverage. But if you don't, and you're pathetic, and you've got the unions breathing down your necks, and Tata knows that, they're just rolling the dice. They're just better. It's just brinkmanship. They're better negotiators. We look at the deals that Trump's done. So, like he said, well, okay, NVIDIA, you can go and flog. You can keep selling to China, but I want 15% of the profits. I mean, at least, you can argue whether that's what a government should be doing, but at least it's cash coming in.
No, this
is just cash going out. There's no commerciality.
It's been commercially minded. I think they will. I think there will be warrants. There will be some kind of commercial deal. But here's the kicker for me. JLR make bad cars. So if you've got somebody like BYD building, incredible technology at $20,000, $15,000, and maybe this is a strategic play by Tata to go, fine, okay, well let's see what happens, because this unit is not a massive part of our balance sheet, and B is just it's not a particularly strong, good, useful one. So I don't know where you go when the actual end product is bad.
It's so peculiar that they're willing to guarantee a loan, but are so against tax reductions that might or incentives that might stimulate growth, whereas there's no upside to this really, apart from, well, maybe those people get to keep their jobs. Obviously, we want them to keep their jobs, but there's no scaled upside. There's no exponential upside of doing this. And it just goes to show how ideologically driven the government is.
Well, no, I mean, yes, and don't forget this. This is not just 40,000 jobs. This is 120,000 jobs at risk in the supply chain, right? There's also a bit of pork barreling going on here, as in these are jobs in the Midlands, in a key areas of labour heartlands that they need to keep if they want to actually hold off reform going forward. So there's definitely politics at play here. But to tie this back to the Germany kind of example and debate is, I'm all for, and I think we are all for here on this group, government, investing alongside the private sector to stimulate growth. I mean, the US do this the whole time. I think one thing that we've talked about here is it's not just writing blank checks though as a government. Actually, it's better off where the government is the first customer. Yeah.
Well,
so I think
this is what people don't
that's
realize.
That's a how rather than a sort of what, as it were.
But it is important to note that the 36 trillion in US debt has gone somewhere. And it has propped up private and public markets through various vehicles.
But it's not just about propping up. I mean, it's stimulated activity as well, right? So I think that's what Germany's trying to do. I think what actually the UK government with a smaller budget is trying to do, and they're also trying to obviously, per the announcement with the Americans last week, is bring in foreign direct investment into the UK. I think the question then is, what do you do when stuff goes wrong in the private sector is a question, and we had this on the front pages in the global financial crisis, 2008, 2009. We had it also during COVID. Look, I mean, I think that's a big difference between this. In those cases, they were big external shock factors in big industries where maybe you could argue it's right for the government to step in. Here, you have actually, this is non-core. I mean, you talked about the UK dropping out of the top 20 in IPO fundraising this year, and we used to be number 2 in the automotive. We're now barely in the top 20, right? So this is a dying, moribund industry. And that's the private sector. That's you, Dan, telling us that you don't want to buy a car made by JLR. So government stepping in to rescue what is a moribund industry when, by the way, these people hadn't even taken out cyber insurance. They hadn't done it. They decided not to do it. And we know, and we've talked about it here before, is cyber is probably top of the risk register of all companies at the moment. So it's not as if this is some external factor that they can hold their hands up and say, we didn't have a clue this was coming. So they knew it. They knew it was a high risk. They didn't have insurance for it. And they're now asking the government to pick up the tab. I mean, via this guarantee. I think it sets a very, very bad example. And there's this whole moral hazard argument, which is that, everyone else looking around this who employs at least 100,000 people is being like, well, maybe we don't need to go and take out cyber insurance going forwards. Maybe we don't need to invest in, the latest cutting edge defenses, because ultimately the government's going to come and pick up the tab. So I think that's the most dangerous thing here. So yeah, there are times when it's justified for the government to step in when stuff goes wrong. I don't think this is one of them. And you can call me heartless, but I'm afraid this is how, if you want to live in a capitalist society, I'm afraid this is the way the cookie crumbles.
I think it would just be such bad politics right now for the Labour government. I just don't think they'd survive it if JLR went
this is
under.
a lot of jobs now. It's 120. If it's 150,000 jobs, I mean, just for context, that is actually the number of jobs that have been lost in the UK since Rachel Reeves took charge. So it's a whole year's worth of job losses. That was the national insurance rise, yeah.
Oh my goodness! All right, well, let's listen. I want to have a conversation.
I don't know, Dan.
Both.
Would you write the check? Would you write the guarantee here?
I would,
Okay.
but I would take warrants. I would absolutely prop them up. I would absolutely have stern words with Tata, and I would absolutely
you take warrants.
make
You
sure there
basically
was
do
some
a bit of Trump and Intel. Trump.
Yeah, totally.
Trump might do
He's
the
shown the
deal
way.
here, but he'd do a better deal. He's
shown the way. I'm not sure Starmer's got the same kind of negotiating grit,
I think,
really. But
I think the other thing that the other thing
I don't
that
think
actually
it crosses their minds. It doesn't cross their minds.
If you are going to advocate for this kind of thing, I think you also need to drive behavior change in the industry. So the banks got bailed out, but the whole sector, the prudence rules, the solvency rules got rewritten, right? Such that the banks are now much more, touch wood, stable than they've ever been, right? And so I think off the back of this, I would look at actually mandating here how companies, large companies with more than 50,000 or whatever the number is of employees, deal with cyber risk. There needs to be some rules around this, because
they're titanic. They're such slow-moving beasts. I bet their operating manual or manuals across the organization were written in the 90s. This stuff, is such. I mean, AI has obviously accelerated the cyber risk path. It's just, I bet they're not even thinking smart about these things. I bet it's just an oversight. Not even a conscious choice would be my fear. Right. I want to have a conversation with you both that I've tried to have many times, and it never goes well. And I want to talk about venture capital business models, 2 and 20, RIAs, new models, debt financing, equity hybrids, all of this stuff that's I think is going to come through. My thesis is that AI is going to be an accelerant for a change in new models, new ways of getting the right capital into the right teams at the right time. And I've seen, because I obviously have happy ears on this topic, I've seen this week a number of new kinds of funding, new kinds of venture capital come in. We've seen VC firm Striker. They've got one fund, 10 LPs, 10 investments. So they're trying to go toe to toe with the RIAs. Now, if you don't know what an RIA is, it's all of the old big VCs in the Bay are no longer VCs. They are RIAs, registered investment advisors, which effectively means that if you're Sequoia or Lightspeed or Benchmark or Andreessen or one of the big mega funds, you can invest in anything. You can go public, you can go private, you can go soup to nuts from pre-seed all the way through. You can do whatever you want. You are just an investor. You are no longer a venture capitalist, although obviously that depends on the terms that you choose to describe. We also saw this week that AI, I think for the first time, has beaten humans at selecting high potential founders. So they've tested a bunch of models. I think that ChatGPT came up best and Google came out worst. So Gemini did the worst, I think. But I'll check the figures and I'll post that in the comments section. But AI was effectively a better picker of founders to back. We've also seen Ribbit, NEA, Overlap, Pinegrove, and Leapfrog launch in the last few months various flavors of non-traditional special opportunity funds. So there's lots of stuff going on. And so my question for the room is, and it might be a very short conversation, I'm very comfortable with that, but is there an opportunity, especially with Europe in mind, to look at new funding models to suit us better, to suit founders better, to suit our ecosystem better? Lomax, kick us off, and it's totally fine if it's a no FO.
Oh man, this is what Mads, our dear co-panelist,
our compadre,
would call,
hates this conversation.
He would call this inside baseball, wouldn't he? I mean, he'd refer to this. So I think okay. So if you're trying to tie the RIA discussion to Europe, that ain't happening. At least,
well, it will happen at some point.
No,
I mean,
okay.
we're 10 years off, right?
The RIA happens, I think, as a result of the maturing of the industry, and it happens effectively when you have too much or a lot of capital, which is something that we definitely don't have in Europe, right? So I think it's the traditional venture capitalists who are taking normally minority stakes in private companies and growing them, and obviously trying to deliver returns to their limited partners. Basically saying, you know what, we're now going to offer different products to our investors because, we've almost exhausted what we can do with this traditional model. We're now going to take majority stakes in companies. We're going to invest in listed stocks. We're going to do lots of secondaries. We're going to do crypto.
But it could be more attractive to pension funds. It could cajole pension funds if there was a fee aligned or a model aligned way of them getting involved.
Well, the irony, I think, is a lot of this is all about actually these firms, how do they extract more fees rather than actually less fees? So I think that's probably a point of irony
probably
there.
Counter. Okay.
So look, I mean, I think it's a sign of maturing of the industry. Some of these firms have basically got too big for the traditional venture model. They are expanding their product mix, as you probably call it, and becoming north of $100 billion, AUM machines, and they're starting to challenge the likes of traditional private equity types of, BlackRock, Blackstone, who are big, absorbers of capital in both real estate and classic private equity. So I think that's it on the RIA. So I don't think it's coming to Europe anytime soon, except for maybe one or two houses. If anything, it'll just be the European, like the general capitalists who are already very present in Europe, just kind of bringing themselves over and doing different models. And we talked about the general catalyst, big investment in the Ukrainian company Grammarly, right, where they did a kind of revenue. That's a different model. It's a different kind of, at least a different instrument, where they did a investment in return for
they funded marketing
share.
plans effectively, didn't they?
But in return for a rev share, so it's non-dilutive. I think early stage venture capital, I still think is quite artisanal. Maybe I would say that because I'm part of the old guard and I'm advocating for myself, but I still think it's around finding amazing people and convincing them to take your money and helping out where you can and trying to deliver outsized crazy returns off the back of that. So I think there are more data-driven models, certainly where there is more data, which tends to be Series A and above. So we're seeing, and you've seen Nick Storonsky out of Revolut's new fund, Quantum Light, that's using a lot of data. And pretty much every firm now has either got its own data strategy or is using one of these off-the-shelf tools like, Harmonic, Morpheus, Spectre, Amy. Is it Amy? Is that Amy? Is one of them called Amy? I don't know, Landscape. But my point is there are tweaks to the model, which is basically using more data, etc. But I don't think there's any wholesale difference from the tradition of finding amazing people at the early stage and giving them money.
I think you've got a couple of things at play depending on where you look in the stack, to Lomax's point. I mean, earlier stage, when you're not talking about billions of dollars, then we are always, as managers, pitching to the market. We think we're pitching track record and strategy. Actually, what we're pitching is reputation, access, and differentiation, I think, to most LPs. So there's always a pressure there to differentiate yourself. Why are you different? Why should I give you the money? Sure, you need a base level of performance for that. But beyond that, many LPs are looking for something different. They're perhaps looking for diversity. And beyond ticking the prerequisites they have for their own thesis, their own fund or the asset class and the type of assets and stage and the risk they want to take, they're looking for managers who've got a story. So if you take one of the companies that was mentioned, is Vasa, is it? I can't remember the name. Talking about ultra concentrated approach. That's different to someone like us that does 50 investments very early stage. So you've got that. The fact that you just have horses for courses, you're going to have early stage managers offering different products, different people who have different belief set and how you should structure a portfolio. Later stage, when you're talking about the hundreds and millions and billions, you're operating more like a PE firm. And so structurally, you're going to do whatever is optimal to manage those assets. And I think the reason why you get these huge firms is largely because at that point, it's almost more like an index play. You invest across assets which are already on a trajectory. You're not looking for 100x from a Series C or a Series D. You've got more predictable returns and you become almost a default call for a founder if you're one of the 20, 30 firms, however many there are, that have got multi-billions under management. So it's almost platform as a product there. You need the fees if you're going to run 100 people to run a large fund, but equally it's sort of self-fulfilling if you're sitting on that much capital.
You're saying, you're only talking on one side of the seesaw, but you're basically saying there's no new model behind the scenes as far as you can see.
AI is going to change things, but
I believe that
ultimately we're talking about the reason why a fund in the UK or the US is structured is a lot of it's driven by tax. It's tax structuring. It's a perversely complicated model. It doesn't really need to be that way. So that's always going to be a big driver. Beyond that, how much a differentiated model improves outcomes, I'm unconvinced, or is better for the founders. We've talked before on this podcast about sort of non-dilutive funding. So great for some companies, that's going to be great. But I think you're just, as the ecosystem grows and the amount of capital going into tech in VC, which is becoming an ever bigger umbrella, you're just going to see more different approaches. And that's just a natural expansive product.
We've seen lots of secondaries products recently. So there is, And obviously secondaries came out of, the crush post ZERP. Obviously LPs needed to get some liquidity back. So I think we borrowed from the PE playbook and marked our own homework and then created some continuation and or secondaries. So that's all part.
Got to keep the flywheel going, because if money's not moving, then it jams up the whole system.
Okay, all right. Well, listen, I am going to keep poking the bear on this one, because I think there's more to this story, and I know that it's an unpopular one with you, and thank goodness Mads isn't here, because he would punch me in the face. But I'm going to keep poking the bear, because I think there's more to come on that.
I think it's easier at the later stages where there's sort of more data and transparency and information. The whole point about early stages, there's
But that's going to be done, Lomax. AI is going to crush that space.
That's what I mean. That's what I said. There's more to be done with automation and disruption there. I think at the early stage where you can come up with rules-based systems where there is data. I think in a way, if you think about the trickle down of capital from the pension funds, from the family offices, from the insurance companies, like that, we are all part of that. We are all middlemen in that flow down of capital, right? And there may be 2 or 3 middlemen or middle people in between us and that money. But that is the sort of game that we play in. We play effectively. That's why, capital trickles down. And ultimately, if you can automate some of the deployment of that capital, then you can remove people like me, you and Andrew from that discussion. I think that is a little bit easier. Again, this is a wider argument. I think at the very, very early stage where there's less data, I think it's a lot harder to come up with kind of, like rules-based systems. People will try. People are trying, right? But I just think at the very, very early stage, it's a lot harder to do.
Well, my darlings, it's time for Deal of the Week. I'm going to go first because I just want to give a shout out to Reese from Concept for raising his second fund, biggest pre-seed, I think, in Europe at 88 million. So a massive round of applause. I will now insert
Awesome job.
Rocket emojis and rounds of applause into the podcast. Lomax, what's yours?
Well, firstly, Creator Fund have just also announced today their first pan-European fund. They're a sort of deep tech, university-led spin-out fund. So congrats to Jamie and team there. I think that's an 80 million euro or dollar fund.
Yeah.
I think the biggest deal of the week at the company level is actually a US deal, I'm afraid. Even though there's lots of cool European stuff, which maybe I'll touch on in a minute, is Periodic Labs has just come out of stealth this week with a $300 million seed round backed by, A16.
It's a whole new ball of wax, isn't it?
A16Z, yeah. DST, NVIDIA,
We did a $500 billion pre-seed.
And Jeff Bezos. I mean, I think what's interesting here is, so these guys are team out of Google Brain and DeepMind, and they're focused on material discovery. So using LLMs to generate new research and discoveries in material science. Interestingly, we were talking about two weeks ago about Cusp AI out of Cambridge, raised 100 million in Europe. So this is the kind of classic example of the US, like anything you can do, we can do better.
Nice.
We celebrate 100 mil rounds, they go and knock everyone out of the park with a 300 mil round. So it's just a reminder of when we get very excited about some things here, which rightly we should do. The US is moving on. But if we want to talk about Europe, there's a lot going on. Jesus,
yeah, tell us more.
So legal tech Ligora is now having raised an 85 million series. I think Series B in May is now in the market for $100 million plus Series C at a 1.7 billion valuation.
Nice. The Swedes are crushing it.
They are crushing it, and legal tech is so hot right now.
Who would have thought? I wonder if 6 months if we're talking about ed tech. Like
having actually been a lawyer, having looked at a lot of legal tech pre-LLMs, that was a bit of a graveyard, to be honest. Like, not a great place to invest. I mean, LLMs are clearly a place. It is a technology ripe for disrupt. I mean, you talk about, for example, listing companies, IPOs. If you want to IPO a company, you got a prospectus which is 500 pages long. Yeah, and it's like that used to be manually written by junior lawyers and bankers. A lot of it's boilerplate, but you can just get LLMs to do that all now,
Yeah.
So there is actually
get LLMs to replace
you're
your
saving
lawyer, surely.
hundreds of hours. And I think in a way it's a good example. Yeah, they'll replace a lot of the menial junior work. Funnily enough, actually, if you're really you want to dive down a rabbit hole, there was a big chat on Reddit this week where a lot of people were Harvey AI, which is the big legal tech in the US, which raised a lot of money. There was a lot of people on Reddit, mainly lawyers actually, dunking on the Harvey product. Funnily enough, one of the competitors of Harvey came out, maybe in a kind of guerrilla marketing or orthogonal way of approaching marketing, say, defending Harvey AI in this
Really?
big. Yes, I know. Normally they would.
I've never
jump in
heard
and
good
try and
things about the product.
steal users. Anyway, Legora, Sweden, so hot right now. German AI startup, Black Forest Labs, only founded last year. The team that came out of Stability AI is now in talks to raise 200 to 300 million at a 4 billion valuations. That's one of the kind of biggest companies that you've never heard of in Europe, I'd say.
What do they do? I've not heard
Advanced
of them.
image generation. Advanced image generation.
Okay.
Hence they're out of Stability AI.
Right.
Clio and Tide both became unicorns. And finally, Anton at Lovable put on his, Dr. Evil voice and announced that, Lovable's going to be a $1 trillion company. So
What?
So yeah, lots of stuff going on and exciting times.
Andrew, what else from you before we close off?
Guys, at the Resilience Conference beginning this week in London, an amazing group of defense, government, startups, tech, all looking at defense, cyber, everything, you name it. Some very interesting high-profile people over from the US. We had Q, as in James Bond Q, the real-life Q from MI6, do his first public interview, which is fascinating. I can tell you that he said one of his favorite he was asked what his favorite gadgets were, and he said a lot of them he couldn't talk about, but one of his favorite he could talk about was a surveillance dog poo, which was one of his favorites. So these things do exist. But yeah, lot of investing going on in the defense space. It's really picked up now. Too many to list actually, but the last 10 days, unmanned defense drones, 2 million pre-seed. Actually from a later stage fund from Excel and Special Invest, Avantra, which is sort of is to make gliding munitions more accurate. So yeah, lot really picking up. It was really good to see a lot of positivity. And I think AI just a couple of months ago started investing in probably old news, but Keen Ventures, I only read recently, took 40 million from the EIF, which is a defense and cybersecurity, fund. So
are they UK
people are
funds?
waking up
Where are
finally,
they?
and we're moving.
Netherlands.
Okay.
Yeah, the NATO Innovation Fund have invested in a bunch of funds, including I think Keen.
Yeah.
So I saw also there's something on procurement this week where they're trying to cut procurement times across defense in the UK. So I don't know if you know anything more about that, Andrew.
There's been a bunch of initiatives. I think the problem is that the will and the sentiment is there, but it's tying it all together. It's still such a, as you can imagine, the military and the MOD is such a maze for anyone trying to access it. But I think we'll get there. One of the things that struck me, I just want to keep banging this drum, is they had some pitch sessions, and the ambition on urgency of sort of European companies versus the US there is still a big chasm there. And this has to come from both investors but also from founders. And there was a aerospace startup talking about building its first vehicle. I won't say too much because I don't want to sound too neggy Nancy online, but they said they'll have their first product by 2029. I thought it's just too damn long. I don't even need to know anything about what you're building to know that it's too long. And conversely, they had someone speaking from Hermeus, which yes has had tens of millions put into it, dollars in VC funding, but they've built the world's fastest aircraft unmanned for surveillance, and they built that in 204 days from paper design to a flying aircraft. And so when then when another company, European company, comes on stage and says, well, yeah, we're raising a seed and then we're going to have this in 4 years, it's like, what are you talking about?
So a US firm, Andrew?
The Hermeus, yes.
Yeah. Okay. I'm not going to end on a downer. I want something positive from you, Lomax. Tell me something awesome.
Jesus. In the week of
You could just switch my comments
Flick
around.
through
Dan, you could
notes,
just switch
flick
my
through
comments
notes.
around. So why don't you put my
the Labour
you put my
conference.
neggy comment before the other comments, and then we'll end on a positive.
Come on.
Don't put it on,
Like,
don't put it on the edit.
Still on the edit.
I mean, look at this. Look at what's happening with the companies I just mentioned. That kind of stuff wasn't happening 3 to 4 years ago. So yeah, it's been a big week.
Yeah. And it's been. Do you know what? Sometimes we have some fairly slow news weeks. I was pulling things out of the docket this week. So, gentlemen, it's been a pleasure and a gift, and I will catch you next week.
Bye.
Upside.